Hello guys, this is chapter 7, and this chapter we're going to discuss about bond and the valuation. We're going to discuss about what is a bond, where can you buy a bond, what are the key features of bonds, and then we're going to discuss about how you determine the bond value. If you know the bond value, how you determine the bond yield, and we're going to see how you can assess the risk of a bond. But first, let's discuss about the bond and the bond market. So a bond is a long-term debt instrument in which a borrower agrees to make payment of a principal and interest on specific date to the holder of the bond. The bond is like a car loan. A car loan also is a debt instrument for which you also have to pay a principal and interest. However, the difference between the debt or the bond and the car loan is that for the car loan, every period you're paying part of your principal and you're paying part of your interest. For the bond, what will happen is that every period you're going to pay only your interest, and then when you get at maturity or when you get at the end of the bond, you're going to pay for your principal. So your principal, you only repay your principal at the end of the bond interest. So primarily where you find bonds, they're traded on the over-the-counter market, so they're traded on the computerized network, and there's no specific place where you can go and say, okay, I'm going to buy a bond. You have to have a trader post in order for you to be able to trade or to buy a bond. And most bonds are traded by large financial institutions, so most likely you're going to see institutions like Vanguard or other institutions would be the one actually trading the bonds. It's rarely individuals that will be actually trading the bond. So if you need information about a bond, whether it's a treasury, corporate or municipal bond, you can go to the Wall Street Journal or you can go to the FNRA market or the FINRA market. And to go there, you just have to type FINRA market.morningstar.com. So here I already opened a page. Okay, and when you do that, it will show you the home page for the market information from FINRA. So then let's say that you want to have information about the bonds for Apple. So then you're going to go to the search field and type Apple, and like for Yahoo Finance, is going to show you the ticker of Apple, the name of Apple and the market, so you press that. So when you press that, the first thing it's going to show is the equity details. Remember, here we're not looking at equity, we just need information about bonds. So what we're going to do, on the equity details, they have quotes, options, profile and bond issue. We're going to press bond issue. So when you press bond issue, it will give you the symbol for each of the bond, the coupon for the bond, which is the interest that you receive for the bond, the interest type, is it a adjustable or fixed interest, the call, if you're going to be able to, the firm is going to be able to call the bond at one point, the maturity, which is when you're supposed to actually pay your principal. So here the Apple is supposed to pay the principal in 2023 for the first example, 2043 for the second bond, 2021 for the third bond, 2024, and so forth, so on. They will show you also the rating, which is a very good feature because it allows you to determine the risk of the bond, and we're going to go over that in a couple of slides. So if you want, you can click on the symbol, and most of the time, if it's your first time going there, they will ask you to agree. They give you the term and they will want you to agree to that. So if you agree to the term, then you can go and look at the information. So when you click on the bonds, it will directly show you all the information concerning the bond, all the feature, the ratings, everything concerning the bond. So I know for most of you, if it's the first time that you actually had to deal with bond, you actually are not sure what are these features and what does it mean when you look at this website. So what we're going to do, we're going to go over the feature, and after that I'm going to come back here and show you the feature for this sample bond that we have. So let's go over the main feature. So the first feature is the par value. The par value is the principal or the face amount of the bond. So it's how much Apple is borrowing with that bond. it's most likely to be paid at maturity, and in every bond is going to be paid at maturity. So you're going to Apple is going to borrow principal, and they're going to have to pay you this principal at maturity. Most of the time, we assume that the principal is 1,000 because bonds are issued as the value of 1,000. So if a firm, for example, needs 15 million, they'll have to issue 15,000 bonds of 1,000. So that would give you 15 million. The second element is the coupon interest rate, and we saw it when we were going over the bond for Apple. So what is the coupon interest rate? It's the stated interest rate generally fixed paid by the issuer. So if you take the example of the car loan, it's the interest that you pay to your bank. If you go back to our contest of bonds, it is the interest that Apple has to pay you because they're taking your money, because they're borrowing your money. So you use this interest in order to compute what we call the coupon interest payment, which is the par value multiplied by the coupon interest rate. The coupon interest payment is how much payment are you paying for your interest every period. Then you have the years to maturity, which refer to how long before the bond must be repaid, or how many years until the bond must be repaid. So it can be 5 years, 2 years, 3 years. It depends of the bond. You have the issue date, which give you information about when the bond was issued. Was it issued in 2002? Was it issued in 2003? Was it issued in 2020? Then you have the issue size, which give you information about how many bonds were issued. Remember, you cannot issue a bond of 15 million, but you can issue 50,000 bonds of 1 million. So the issue size will be how many bonds were issued. 15,000 bonds were issued, 20,000 bonds were issued, how many? And then you have the yield to maturity, which is the rate of return earned on a bond until maturity. It's also called the promised yield or yield. So this is, for example, what is the rate of return that you're going to earn if you take into account your coupon payment, your principal that would be paid at the end of the bond. What would be the interest? And this interest, you have to make sure that you do not confuse that with the coupon interest rate, because the coupon interest rate is stated the day that you sign the contract with Apple, for example, and it's not going to change until the end of the bond, so they're always going to pay you the same amount. However, the yield to maturity is going to change based on the market. Why? Because based on the market, the value of your bond will go up, high, lower, or it will be at the same level. So as the value of your bond change, your yield also will change and to adapt to the market. So always remember, your yield to maturity will be the one that will increase with the market or decrease with the market. The coupon interest rate will not change. The coupon interest rate will be the same payment that you receive every period. So other features, some feature that you can have with a bond is a call provision. So if you remember when we were going over the FINRA website that show you that they had the coupon interest, whether it's a fixed coupon or not, and they had the call. This call is actually what we call the call provision. So the call provision allows issuer to refund the bond issue before maturity if rates decline. So it helps the issuer but hurts the investor, in the sense that if they see that the yield to maturity in the market is lower, so that means that it's cheaper for them to pay off the bond, then they can decide to call the bond and pay off the bond early. That helps them because it allows them to save on the interest. However, that hurts you as the investor because you are not able actually to get as much interest that you are supposed to receive. So in many cases, call bond include a deferred call provision or a declining call premium. So that means that, for example, they would give you the option to actually defer the call provision. So let's say that you have a bond, the bond has a call provision. The company like Apple can come and say, okay, we want to call back 10 issues of bond, or we want to get got back 10,000 bonds. What will happen is that if you have a deferred call provision, you can actually tell them that you do not want your bond to be called. You want it to be called at a later time. So then you're able to defer that. Another element or another provision that you can have in your bond contract is the sinking fund provision. So the sinking fund provision allows the company to pay off a loan over its life rather than all at maturity. So instead of having to pay all the principal at maturity, the sinking funds provision will allow them to pay part of the loan or part of the bond before maturity. So it's similar to an amortization on term loan. So it's similar to paying your car loan, so where you pay both your principal and your interest. So how will they do that? So most of the time they will have percentage of bond that they're calling a certain period. So they may say we call 5% of the issue at par for sinking purpose at, let's say, year 2, year 3, or something like that. So then when they're going to do that, they're actually going to pay both the principal and the interest of some of the bond or the 5% issue, and they will be able to retire these bonds. Or the second thing that they can do, they can go to the market and buy the bond back themselves. So they can go to the market and buy the bond back, and when they buy the bond back, they're able to actually repay the owner of the bond with his principal and whatever interest that they have to pay for the payoff, and then they're done. So that's how they can do the sinking fund. Other type of bond that you can have a convertible bond. A convertible bond is a bond that can be exchanged for common stock of the firm. So if you have a convertible bond at a period in time, you can decide to actually change this bond into stock, and there is actually a ratio, so they can tell you for one bond you can get 2 stock, or for one bond you can get 3 stock, and then that's how you're going to exchange it. And it's at your option, so you can decide to exercise the option of converting your bond, or you can decide not to do it. They also have a warrant option, or a warrant type of bond, which is a long-term option to buy a stated number of shares of common stock at a specified price. So it will be a bond also that what they will say is that, okay, with this bond, instead of repaying your principal and interest, we give you the option to be able to pay a number of shares of the stock at the price maybe of 10,000 in the future. That would be a warrant bond. You can also have a puttable bond, which allows the holder to sell the bond back to the company prior maturity. So the puttable bond is actually the inverse of the callable bond or the call provision. With the call provision, the company can actually buy back the bonds prior to maturity. For the puttable bond, you, the holder, can actually decide to sell your bond back to the company prior maturity. You have the option to do it, the company, and you'll be the one actually starting the process to sell your bonds, not the company. You also have an income bond, which pays interest only when interest is earned by the firm. So this type of bond will only give you an interest if, for example, the income of the firm was increasing or the value of the firm has increased. If there's no increase in the value of the firm, then there's no payment for you. Then you have the indexed bond. The indexed bond are bond with interest rate paid based upon the rate of inflation. So what will happen for the indexed bond? If inflation goes high, the interest rate on the bond will go high. If interest rate goes low, that means that the inflation is lower also. However, most of the time with indexed bond, they will have a threshold, so they will say, okay, can increase until 10% or can decrease until 2%. So then, yes, your interest rate will change based on the rate of inflation. However, if you reach 10%, it's not going to increase anymore. If you reach 2%, it's not going to decrease anymore. So, before we go over the value of bond or how you compute the value of bond, let's go back to the FINRA website and look at some of the information that we just saw for the future. Okay, so we go back to our Apple bonds. So they gave us the coupon rate. So the coupon interest rate is here. They gave us a coupon interest rate of 2.4%. So that means that if you're the owner of these bonds, Apple is going to pay you an interest of 2.4%. They gave you the maturity date, which is the date at which Apple is supposed to pay you your principal. So here the maturity date is May 3rd, 2023. So that means that on May 3rd, 2023, Apple is supposed to pay the principal to the owner of the bond. And this, if it's you, that means that you're getting that amount on May 3rd, 2023. Here, if you look here, they're telling you that your bond is callable. So if your bond is callable, it means that Apple has the option to actually call back some of the bond before May 3rd, 2023. So maybe in May, they can do it maybe tomorrow, they can do it in May 1st, 2021. They can do it at a period. It depends on them. But they're more likely to do it when they see that actually the yield is going lower. So here they gave you the last trade price, and that will be your bond price. And we're going to see in a couple of slides how you can actually determine the bond value. They also give you the yields from the last trade, so that tell you what was the percentage yield in the market. So if they found that the percentage yield is too low for them and is very low so that they can actually save on paying back the loan, they're going to call the loan. Other information that they give you, they tell you if it's a US corporate bond, so they can tell you the bond type. They also give you the offering dates, and the offering date is what we call also the issue date. And here it's April 30, 2013. They give you the date that the first coupon was paid. They give you the amount that they had for their initial offering. So if you want to know the issue size, you just have to do 5,500,000 divided by 1,000. That will give you 5,500. So that will be how many bonds they actually issue. They tell you at which frequency you're going to receive your coupon payment, which is here semi-annual. They provide you with the coupon type also here, telling you that the coupon is fixed, and they provide you with the coupon rate or the yield at offering, the yield at offering. So when they were offering the bonds, what was the yield in the market, and the price at which they offered the bond in the market when they offered the bond. So if you look at that and you compare that to the information that we have up here, based on the last traded price, we see that the price of the bond is going high and the yield in the market is going low. So the bond is actually worth more right now. Okay, so now let's go over how you value a bond, or how do you determine the value of a bond. So when you're trying to determine the value of the bond, there's two elements that you have to look at. First, you have to look at your principal amount or par value and your coupon interest payment, which we're going to call hint here, and your principal amount or par value will be the M as your maturity amount. So your principal par value is, if you remember, the amount of money that the firm is borrowing and is going to repay at maturity. The coupon interest payment is actually, in terms of dollar, what interest are they paying each period. So if the coupon is 2.4%, if you multiply that by 1,000, how much are they paying every period? So it's a specified number of dollars of interest paid each period on a bond, and generally each 6 months. So then let's draw the timeline, which is here, and see what will happen to you as a bond holder. So what will happen? Every period you're going to get your coupon interest payment, which will be 2.4% if we use the example of Apple times 1,000. So then you get that in the first year, and you get that in the second year, and you get that every year until you get to maturity. So until you get to maturity, you're going to get 2.4% of 1,000, which will be $24. If we use an example from Apple, $24, $24. So then at maturity, you're going to have what's the principal amount for the bond. So if you're looking at one bond, your principal amount is supposed to be 1,000. So you're going to receive the 1,000 at maturity. So this is how your cash flow is going to look. And this actually reminds us time value of money that we saw in chapter 5, where you had different cash flow every year, and then you're supposed to compute what will be the present value of this cash flow. Computing the value of the bond is actually computing the present value of both your coupon interest payment and your principal amount or maturity amount. So for you to determine what's the value of the bond, you have to determine the present value of all the coupon interest payments. So if you get 24 every period until maturity, what is the present value of the 24 that you get every period until maturity now? Then you're going to compute the present value of your amount or lump sum that you receive at maturity. So your lump sum that you receive at maturity is 1,000. So you're going to compute what's the present value of 1,000 at year 0. And the value of your bond will be equal to the present value of your coupon interest payment plus the present value of your principal or of your par value, and that will give you the value of your bond. So in sum, how do you compute the value of the bond? The value of the bond is equal to your present value plus the present value of your coupon interest plus the present value of your par value at par value that you receive at maturity. So if you remember, present value of the coupon payment is the same than having the present value of an annuity, because you're receiving the same amount every period. So you're receiving 24, 24, 24, 24, 24 until the end. So then that's the same thing as doing computing the present value of an annuity. And then if you're trying to compute the present value of the par value, which you only receive at maturity, it will be the same than computing the present value of a lump sum. So if you remember when we went over time value of money in chapter 5, we had an example where you only invest the amount of money now and you get the money in the future, or you only receive 1 million 3 years from now, and what is the value today? So this will be the same. So what you're going to do, you're going to use the formula that we use to compute the present value of an annuity, and add that to the formula to compute the present value of a lump sum. And this is what we have here. So if you have an annuity, your present value of annuity will be equal to the sum from t equal 1 to n, which is from period 1 to period n, of the present value of the coupon interest payment for each year. So then you're going to do coupon interest payment divided by 1 plus the required rate of return, and that will give you the present value of the annuity. And then you're going to add that to the present value of your par value, which is par value divided by 1 plus the interest rate to the power of the number of period, and that will give you the present value of your par value. So if you're trying, for example, to use the formula, so you're trying to compute using the formula, what you're going to do is first compute the present value of the annuities using this formula. Then you're going to compute the present value of the par value, and then you're going to add them together. If you're using your calculator, it's a little bit easier, because in your calculator you already have the formulas built in, so you do not have to go step by step. So if you're using your calculator, you're going to go back to input output, so you're going to put information for like your number of period, your interest, present value, future value. However, in this case, contrary to chapter 5, you're going to have both a payment and you're going to have a future value. So in chapter 5 we have different cases. In first case, you add a future value in the future, like a lump sum, and you compute what will be the present value. In the second case, you have an annuity, which is payment that you receive every period, and you compute the present value. In this case, you're going to actually use both. So you're going to input what is your payment, and your payment will be your coupon interest payment, and then you're going to put what is your future value, which would be here your par value, and then you're going to put what is your interest rate or yield, what is the number of period or years maturity, and you're going to compute for your present value. And your present value will be the value of the bond. Your payment will be your coupon interest payment, which is equal to your coupon interest rate times your par value. Your yield to maturity will be your interest that you use here. Your number of period will be your years maturity. And your future value will be your par value. So you do the same thing that we've been doing in chapter 5. However, you're going to have both a payment and a future value. So let's go over a couple of examples. So here we have a 10-year bond with 10% annual coupon, and the yield to maturity or the interest is 10%. So they're asking you what will be the value of the bond. So one thing that you can determine is that since it's a bond, each bond are issued as an increment of 1,000. So we'll say that the value of the bond will be 1,000 at par value. So here we're only looking at one bond, so we're going to say that the value of the bond at par value, the par value of the bond will be 1,000. They're telling us this is a 10-year bond, so that means that the maturity will be in year 10, so the bond will mature in year 10. Then they're telling us that the coupon rate is actually 10%. This information is good because it allows us to determine the coupon payment or coupon interest payment, and how do you compute that? That will be your par value, 1,000 times 10%. So 1,000 times 10%, that will give you 100. So you're going to have 100 as your coupon payment every period. So then they gave us the interest rate or the yield, which is here 10%. So then they're asking you to find what will be the value of the bond. So if you're using your calculator, this is what you're going to do. Okay. You're going to put in the number of period. Here it's a 10-year bond, so your number of period will be 10, so you're going to input 10. You're going to put in the interest. They told you that the yield maturity here is 10%, so then you're going to have 10% as your interest. You're going to put your coupon interest payment, and we computed that, and that gives you 100 coupon interest payment, so you're going to put that as your payments. And then your par value is 1,000. You're going to put 1,000 as your par value, and you compute for your present value. That will give you 100,000. If you're using Excel, what you're going to do, you're going to use the Excel function for present value, which is here. You're going to put your interest first, and that will be your yield as a decimal. Then you're going to put the number of period, which is 10 years here. And then you're going to put your payment, which is 100 here. And then you're going to put your future value, which is 1,000. And it will ask you for your type. You're going to put 0 because we assume it's an ordinary type. So the question will be, why didn't we put minus payment? Because we're trying to compute the present value, and the present value will always take the minus sign. We assume that you pay the present value in order for you to get a payment of 100 and the future value of 1,000. So that's why we didn't put a negative sign for the payment. So let's try to compute that in Excel. Okay, so if you remember, that's the Excel sheet we actually use for chapter 5, time value of money, and I'm using the same Excel sheet to show you that it's actually the same thing that you did in chapter 5. However, this time you have to have a future value and a payment. So here they told us that the par value is 1,000. The interest is 10%, so you put it as a decimal, 0.1. The number of period is 10. The payment is 100. So then you're going to go equal present value, open the parentheses. You select your rate. You select your number of period. You select your payment. You select your future value. It's going to ask you for a type. We're going to assume that the type is 0, end of period. You only assume that it's beginning of period if the exercise, if the contract says that it's beginning of period. If there's no mention of beginning of period, always assume that it's end of period. So we're going to put 0, close the parentheses, press enter, and it's going to give you the present value, which is 1,000. And this is the same thing that we found here. We found that the future value and the present value are actually the same. The reason why we found that the future value is the same than the present value here is because in this case we have a interest rate which is the yield, which is the same than the coupon interest rate. So because you have the same value for your coupon interest rate, you're going to have the same value for your future value and present value, and this would be called a par bond, or a bond that's selling at par. So that means that in this case you have a bond that's selling at par, or a par bond. Let's go over another example. So here you have the same bond, however, now instead of having a coupon rate of 10%, you're going to have a coupon rate of 13%. So what will happen to the bond? So first, the annual coupon or the annual coupon interest will change. It will now be 13% times 100, which will give you 113. Since they're assuming that the risk is the same, so we'll assume that the yield to maturity didn't change, so the yield to maturity is 10%. The maturity of the bond is 10 years. So the question will be, what is the present value of the bond? So to compute the present value of the bond, you're going to put the number of period, or the years to maturity here is 10 years. The interest, 10%. The payment, or coupon interest payment, 130. And the face value or future value would be 1,000. And then you compute for your present value, and if you're using your calculator, that will give you 1,184.34. If you're using Excel, you're going to have to input the new values. So your future value would be 1,000. Your interest rate, which is the yield, is still 10%, so you're going to put it as a decimal. Your number of period is still 10, but now your payment is 130. So then you go equal present value, open the parentheses, select your rate, then select your number of period, then select your payment, then select your future value, then press 0, and you press enter. That will give you minus 1,184.34. So your present value will be minus 1,184.34, which is the same amount that we found here. So here, what do you notice? You notice that your present value is actually higher than your future value. So what does it mean for the bond? It means that the bond actually sells at a premium. So why do we know that the bond sells at a premium? Because first, the present value is higher than the future value, and also your coupon interest rate, 13%, is higher than your yield to maturity, which is 10%. So then we will assume that that's a premium bond, so it's still at the premium, it's still at a higher price than its actual value. This is also another example that we're going to go over, but in this case, the coupon is changing to actually 7% of the par value. So now the coupon interest rate is 7%. So if you multiply that by 1,000, that will give you $70. So $70 is what you have for your coupon payment. The risk is still the same, so we assume that the yield is still 10%. The maturity is still 10 years, and the future value is still 1,000. So then they're asking you to compute what will be the value of the bond. So to help anybody that is planning to use the calculator, I'm going to use the calculator for this example so that you can see what you're supposed to do with your calculator. So what you're going to do, you're going to put your number of period here, 10 years, so 10 number of period. Then you're going to input the number of the interest rate or the yield to maturity, which is 10 here. Then you're going to input your payment. In this case, the payment is 70. And then you're going to compute or impute your future value, which is in this case 1,000. And you're going to compute present value. That will give you minus 815.66, which is the same thing that we find here. If you're using Excel, you just have to put equal present value, select your rate as to decimal, select your number of periods, select your payment, and select your future value. And if you do that, you're going to find the same answer, which is minus 815.66. So let's look at our present value and future value. In this example, what do you see? You see that the present value is actually lower than your future value. Your future value is 100,000. Your present value is 815.66. So what does it mean for this bond? We're going to say that this bond sells at a discount. It sells at a price that is lower than the future value. Another way that you should have known that is by comparing the coupon rate to the year to maturity. In this case, the coupon rate is 7%, while the year to maturity is 10%. So 7% is lower than 10%. So your coupon rate is actually lower than your year to maturity. So for this case, we're going to say that your bond is actually selling at a discount. So that means that if you go to the market and you try to buy this bond, what will happen? You're going to buy this bond at a cheaper price, and then you're going to have a higher amount at maturity on the bond. So the question will be, what will happen to the premium bonds, the discount bond, the par bond at maturity? This graph actually shows you how the bond value will change over time and what will happen for the three different bonds. So if, for example, you have a bond that's selling at par or a par bond, that means that the value of your bond is not going to change until you get to maturity. You're always going to have the same value for your bond. If you buy the bond at a premium in the market, what you should expect is that as the time goes or as the years to maturity increase, the value of your bond will actually go down until you reach your 1,000. If you're buying a discount bond, what will happen is that the value of your bond will increase until you reach the same 1,000. So what you can say in general for a bond is that whether it's a premium bond, a par bond, or a discount bond, all these bonds will actually have the same value of at maturity, which is 1,000. So if you go to the market and you buy a discount bond, you assume that you're going to have a profit if you keep it until years to maturity, until maturity. If you buy a premium bond, the assumption is that actually the value of your bond will decrease until you get to maturity. If you have a par bond, the value of your bond is not going to change until you get to maturity. Okay. So most of the bond, the example that we saw so far for the bonds are based on annual payment. So they told you that the coupon interest will be paid annually, so you have an annual coupon interest. However, in the real life, what you see is that most bonds you will have actually semi-annual payment. So for example, let's look at an example with Apple. So if you look at here, payment frequency, it's not annual, it's semi-annual, and most of the bond will be like that. So you're going to have a coupon to receive a coupon twice in a year, so 2 payment of your coupon during a year. So then how do you compute the value of a bond if you know that you're going actually to receive 2 payments in a year? This is what you're going to do. So first, you're going to have to change some of your values or some of your input in order to reflect that it's a semi-annual. For the number of period, if they give you a number of period of 10 years, you assume that it's actually multiplied by 2 because you're going to get 2 payments in a year. So you're going to do 2 times 10 years, that would be 20 years. For the periodic rate or for the yield to maturity, the yield to maturity is always given to you as an annual rate. So what you're going to do, you're going to divide the yield to maturity by 2, and that will be your periodic rate that you're going to use in your calculation. And finally, the coupon payment or the annual interest coupon interest payment, what you're going to do, you're going to divide that by 2 also, because you're going to have equal amount of your annual interest payment or annual coupon payment during the year. So there's 3 elements that you're going to change. You're going to change the number of periods multiplied by 2. You're going to divide your nominal rate by 2, and you're going to divide your annual coupon by 2. So then this is what you're going to input in your calculator. Number of period will be 2 times the number of years. The interest will be the year to maturity divided by 2. The payment will be the coupon interest, the annual coupon interest payment divided by 2. And your future value, you're not going to change it, it's still going to be 1,000, and you compute your present value. So let's go over an example. So what if, what is the value of a 10-year bond that has 10% semi-annual coupon payment and a yield to maturity of 13%? So now this coupon is a semi-annual coupon, so you're receiving 2 coupons in a year. The yield to maturity is 13%, and the number of period is 10%. So what are you going to do? First, you have to change the number of period to include the 2 payment. You have to change the coupon payments to include the 2 payment, and you have to change also the yield to maturity. So what are we going to do? We're going to multiply the number of years by 2. Here we have 10 years. 10 times 2, that will be 20 years. Then we're going to divide the nominal rate by 2. Here the nominal rate is 13%. We're going to divide by 2, that's 6.5. Finally, your coupon interest payment will be 10% of 1,000, which is 100, and you divide that by 2, that will give you 50. So then you're going to now input number of period 2, interest rate 6.5, and payment 50. Remember, you do not change your future value, so your future value will still be the same. So then, what do you do if you're using a calculator? Number of periods 20, interest 6.5%, payment 50, future value 1,000. You press compute, and it's going to give you the present value. If you're using Excel, your future value will be 1,000. Your interest will be 6.5%, which is in decimal 0.65. Your number of periods will now be 20, and your payment will be 50. So you're going to put equal, select your rate, equal present value, sorry. Select your rate, select the number of period, select the payment, select the future value, and we assume it's end of period 0, and press enter. So that will give you 834.72, which is the same thing that we found for using our Excel sheet and using our calculator also. So now we know how to compute the price of a bond. We know how to compute the price of a bond, whether it's a semi-annual bond or annual bond. What we need to discuss is how do you determine the yield when you're already given the bond price? So if you go, for example, to a Apple example, most of the calculation that we did so far were to find this value, which is the price. So the question is, if you already have that, how do you compute the yield, or how do you determine the interest in the market? So to do that, we're going to use the interest key on your TVM, or for example, you're going to determine what's the rate in Excel. So let's look at this example. So they have a 10-year bond, 9% annual coupon, 1,000 par value, selling at 887. So you know the price, you know the par value, you know the coupon, you know the number of years, but you do not know the interest rate or the yield. So the question is that you must find the interest rate in order to solve this model. So if we go back to our formula, the value of a bond will be equal to the sum of the present value of the coupon interest payment plus the present value of your face value. So in this case, you have 9% as your coupon, so your coupon interest payment is 90. So you're going to find the present value of 90 for each year until year 10. And then in year 10, you're going to get your 1,000, and you need to find the present value of that also. Here they already give you the value or the present value, and they want you to determine what's the rate. You can try to compute the rate using the formula, but that will be more like a trial and error, so you have to put different rates until you're able to get a value of 887. Or you can actually use your Excel sheet or your calculator, and that will be a little bit quicker. So let's solve for the yield to maturity using the calculator first. They provided you with information concerning the number of period, the payment, the present value, the future value. So what you're going to do, you're going to input all this value in your calculator and solve for IYR, which will be your yield. So you're going to do number of period equal 10, payment 90, future value 1,000, present value minus 887, and compute for the interest rate. So if you use your calculator, and always remember to clear your TVM, you're going to have 10 as your number of period, 90 as your payment, 1,000 as your future value, and 807 as your present value, and you compute for your interest, and that gives you 10.91. If you're using Excel, which we're going to do here, you're going to input the value that you have, which is 1,000 for your future value, minus 887 for your present value. The number of period is 10. Your payment is 90. So then you're going to use the function rate. So you're going to put equal rate, open the parentheses. It's going to ask you for the number of period here is 10, the payment 90, the present value 887, the future value 1,000, and it will ask you if it's an end of period or beginning of period. We assume it's an end of period, so 0, and you close the parentheses. You don't have to put in any guess. Excel will calculate directly. So you put enter. So Excel will find an interest of percentage of 10.91%, which is exactly the same that what we found for our Excel from our PowerPoint. So solving for IYR, the year to maturity of this bond is 10.91%. Looking at this bond, we see two things. First, you look at the present value and future value. You see that actually your present value is lower than your future value. And also when you look at the yield to maturity, you see that your yield to maturity is higher than your coupon rate, which was 9%. So in this case, we can say that we have actually a discount bond. So if you remember, a discount bond is a bond that has a price that's lower than the future value, and also yield to maturity that's higher than the coupon rate. So in this case, your yield to maturity is higher than the coupon rate. So let's look at a second example. So in this example, they gave us the future value or the first value 1000. Your coupon interest payment is 90. Your number of period is 10, and your present value is minus 1134.20. So I left it blank because I want you to try yourself at home in order to be able to solve what is the interest rate. You can either use your calculator or your Excel sheet. However, when you're going to solve that, you're going to find that your interest rate is 7.08%. So what I want you to do is try to yourself to compute this value and see if you're able to find 7.8%. That would be a good practice for you for the practice question and for the exam. And one thing that you will notice when you're going to do that is that actually your bond sells at a premium, because your yield to maturity is going to be lower than your coupon rate, and your price is actually higher than your future value or your face value. But I'm leaving that blank for you, and I want you to try to compute these interests. So other type of yield that you can have and that are related to your yield to maturity are the current yield and the capital gain yield. So one thing that you have to notice, and I'm sure that you have noticed by now, the yield to maturity is actually similar to having a return on your bond. If you remember from your chapter on rate of return, in the overview, you had a PowerPoint that was going over how to compute return, and you had to compute the difference between the price of the asset plus the income that you receive divided by the beginning price of the asset. So this is actually what you do also for the yield to maturity. However, you use your calculator in order to compute the yield to maturity. And the yield to maturity will be equal to the same thing, which is changing price plus income divided by beginning price, and that will be actually the capital gain yield plus your current yield. So instead of calling that the dividend yield for the bond, we're going to call that a current yield. So your current yield, contrary to the stock where you use a dividend, will be equal to your annual coupon divided by current price or beginning price. Your capital gain yield will be the change in price divided by beginning price. So it will be ending price minus beginning price divided by beginning price. So if you have the yield to maturity, you can determine what's your expected coupon payment, and you can determine what is your capital gain yield. If you have the yield to maturity and the current yield, you can determine your capital gain yield. If you have your yield to maturity and your capital gain yield, you can compute the current yield to maturity. So let's go over an example. They're asking you to find the current yield and the capital gain yield for a 10-year 9% annual coupon that sells at 887 and has a face value of 1000. So then what do? The current yield, you'll need the annual coupon, which is here 9% of 1000, so that will be 90. And you divide that by the price at which a bond sells, or the beginning price, which is here 887, so that will be 90 divided by 887. That will give you 10.15%. So for these bonds, your return that you receive that is only due to your coupon is 10.15%. So then you will also have to compute the capital gain. If you want to compute the capital gain, Here, did I give you the price for the ending price? No, they only gave you the beginning price. So you cannot do ending minus beginning divided by beginning. You do not have the ending price. What you can do is remember that yield to maturity is actually equal to current yield plus capital gain yield. So if you have the yield to maturity, if you have the current yield, you can actually compute the capital gain yield. And if you remember in the previous slide, we already computed the yield to maturity for this bond. So going back to our Excel, we found that the yield to maturity was actually 10.91%. So we're going to use this 10.91% to actually compute what will be the yield to maturity. So let's go back to our PowerPoint. We're going to have 10.91% minus the current yield, 10.15%. That would give us the capital gain yield, which is 0.76%. So for this period, or for this year, the capital gain yield was 0.76%. So if you have the yield to maturity, you can actually compute the current yield and capital gain yields because you also have the coupon. So then you can actually compute what will be your current yield, remove your current yield for your yield to maturity, and compute your capital gain yield. So these are the type of yield that you will have if you have a bond. So far we went over how to value a bond. We discussed about yield in terms of yield maturity, current yield, and capital gain yield. Another element that we're going to discuss about is the yield to call. So if you remember when we went over the provision, we saw that a bond can have actually a call provision. This call provision will allow the company that issued the bond to call back the bond at a period before the end of the bond or before the maturity. So then if you're the owner of the bond and Apple is going to call the bond, you as an owner, you're going to receive what we call a yield to call. This yield will be how much interest do you get by giving back the bond before maturity at the call price. So let's see how you can compute the yield to call. So here they gave us a 10-year, 10% semi-annual coupon bond selling for 1,135.90. They tell you that this bond can be called in 4 years at 1,050, and they want to know what is its yield to call. So to compute the yield to call, you'll need the information about the future value of the bond, the payment of the bond or coupon payment of the bond, the number of periods for the bond, and the present value of the bond. Remember, the present value of the bond is the price, so it was given here as 1,135.90. Here, the future value is not going to be the value of the bond at maturity or the principal, but it's going to be the value that the bank on the value of that the company is going to pay you in order for them to be able to call the bond. And here they're paying you 1,050. They're doing that in 4 years. So if you buy the bond now, you're going to hold it for 4 years until you get the 1,050. So if you have to to compute your yield to call, you're going to use your bond price, your call price as your future value, your number of periods until the bond is called as your years to maturity. Your coupon will not change. It will be 10% of your future value of your face value, which was 1,000, and you're going to use that to compute. So here they already solved for the yield to maturity, and we're not going to solve for the yield to maturity, but we're going to solve for the yield to call. You do the same thing that you do for solving for the yield to maturity, except that the time to call is used for n and the call premium is used for your future value. So this is what you're going to put in Excel. In this case, you're going to hold the semi-annual bond for 4 years before it's called. So then your number of period here will be 2 times 4. That will be equal to 8. You know at which price you're going to buy it today, which is 1,135.90. The coupon payment will be 50. And how do we compute the coupon payment 50? We did the face value or the par value, which is 1,000 times 10%. That give you 100. And then because it's a manual, we divide that by 2. That give you 50. So make sure that if you're trying to compute the yield to call, that you do not use the call price in order to compute the coupon payment, because whether you have a call or not, your coupon payment are always going to be the same. So the coupon payment will always be coupon interest times the face value or par value, which is always 1,000. And if it's a manual, you divide by 2. So that's how we got payment 50. Then the future value will be the call premium or the call price that you get at the end, which will be 1,050. And then you're going to compute for your interest. So let's say that I'm using my calculator here. You clear your TVM. So your number of period will be 8. Your present value will be 135.90. And it's your present value, so it takes minus. Your payment will be 50. Your future value will be 1,050. And you compute IY. That will give you 3.5687837. So 3.57 of roughly 3.6%. So this will be your yield to call. But remember, your yield to call is always an annual rate. So this rate that you found is the interest rate that you get for a semi-annual coupon bond. But however, it's not the annual rate, and your yield to call has to always be an annual rate. So what you're going to do, you're going to use this value and you're going to multiply that by 2. So if you multiply by 2, that gives you 7.14. So your yield to call would be 7.14%. And you can also do that using your Excel sheet. You put your interest, you put your number of period, your payment, your present value, future value, and you compute, and that will give you also the interest. So, as I told you, we found 3.568, which is the periodic yield to call. So then we convert that to a yearly yield to call and multiply that by 2, and that will give us 7.14%. And that will be the rate that you will see quoted on your bond. So the broker is going to quote that as your yield to call. So the question is, when is the call more likely to occur? Yes, you can maybe buy a stock from Apple. It's a callable, but it doesn't mean that the firm will call the bond tomorrow. You don't know when they're going to call, or you don't know if they're going to call. There's actually a reasoning behind the decision that the firms call or do not call the bond. They're more likely to call the bond if it's set at a premium. So that means that the coupon is higher than the yield to maturity. So the call is more likely. So if you have a bond and it's set at a premium, so that means that the coupon is higher than the yield in the market. So in this case, the firm will want to call the bond. Why? Because it's cheaper for them to call the bond than to pay you an interest that is higher than the market interest rate. So in this case, if the coupon is higher than the yield, it's a premium, they're going to call the bond. So when are you going to expect to earn for each type of bond? So if you have, for example, a premium bond, you should expect to get a yield to call, because you should expect that the firms will want to call the bond if it's a callable bond. But if you have a bond that is on par or discount bond, then you can expect that the firm is not actually going to call the bond, because it's more expensive for them to call the bond than to pay your coupon, which is actually lower than the interest in the market. So when do you expect that they call the bond? They're going to call the bond if it's a premium bond. They're more likely to call the bond, and you're more likely to receive your yield to call, but not your yield to maturity. So now we had a discussion about the key feature of the bond, how to value the bond, how to measure the yield of a bond. Now we're going to discuss about how to assess the risk of the bond and what are the different risks that the bond faced. The first risk is the interest price risk, or the interest rate price risk, which is the risk that price of the bond will increase with the market, or the risk that price of the bond will go lower as the interest rate in the market will change. So it's the interest rate risk is concerned with the rising of the yield to maturity, which will cause the value of your bond to fall. So if you have a 1-year bond and you have a change in interest rate, so let's say that the interest rate was 5%, and then the interest rate went to 10%, and then the interest rate went to 15%, what you're going to see is that if you have a 1-year bond, the increase in price will reduce the increase in interest will reduce your price by 5.8%. And if you look at, if you have a 15% bond, you'll see that the increase from 10% to 15% will decrease your price by 4.4%. So if the interest rate was 5% and you bought it at 1,048, then if it's 10%, you're going to sell it at 1,000. It's 15%, you're going to sell it at 956. So that means that you made a loss. However, this loss is not as significant if you had a 10-year bond. If you have a 10-year bond and you have 5%, you're going to have to buy it at 1,286. If the price rose to 10%, then you're losing 386. You're losing 8.6%. If the interest rate goes up to 15%, then you're losing 25.1% out of the 1,000, and you're going to actually selling at 749. So if you have to compare that to the 5%, you're actually losing more than half of the value of the bond just because the interest rate increased. Another risk that you can face as a firm, or if you hold bonds, is the reinvestment risk. However, before we go there, you have to notice that the 10-year bonds are more sensitive to the interest rate risk. So there's a bigger change in price when you have the 10-year bond. But as I told you, there's another type of risk also, which is the reinvestment risk. And with this reinvestment risk, having a 1-year bond is not actually protecting you. And let's go over an example. So what is the reinvestment risk? The reinvestment risk is concerned that interest rate will fall and future cash flow will have to be reinvested at a lower rate, hence reducing income. So with the reinvestment risk, this is what happened. You have the bond for a shorter period, so let's say 1 year. Each time that you get to the end of the 1 year, you're going to get your par value at maturity. This par value, you need to reinvest it in another bond or another 1 year bond at the interest rate in the market. If the interest rate fall in the market, then you have to receive a lower coupon than what you had before. So let's say that you had a bond and the bond had a 10% interest, coupon interest. So that means that you get a coupon payment of 100. After 1 year, you have to receive your principal and reinvest it again. But now in the market, the interest is 5%. So what happened? You're going to actually invest it and get a coupon that is lower, and your coupon will be now $50. So this is what is going to happen with the reinvestment risk. So your risk will be for you to losing 100 and getting 50 as a payment when you could have gotten 100 every year. So let's go over an example. So suppose that you won at the lottery and you got 500,000 playing the lottery. You intend to invest the money and live off the interest. So to do that, you have two choices. You can invest your 500,000 into a 10-year bond, or you can invest into a series of 10 1-year bonds. So one is a 10-year bond that you keep for 10 years, one is a 1-year bond that you have to keep for 1 year, and then you invest to another 1-year bond and do that until you get to 10 years. And the current yield in the market is 10%. So if you choose the 1-year bond strategy, after 1 year you're going to receive 50,000 in income, and you have 500,000 to reinvest. But if the 1-year rate falls to 3%, so then what will happen is that your annual income will fall to 15,000. So that means that in year 1 you get 50,000 and 500,000 to reinvest. However, when you look in the market, the interest is 3 now. So what happened is that you reinvest the 500,000, but now instead of getting 50,000, you get 15,000 the next year. If you choose the 10-year bond, what will happen is that you're locked in that bond for 10 years, and you're locked in the 10% interest for 10 years. So that means whether the interest rate change, increase, decrease, go high, lower, it doesn't matter, because you're still going to get the same 50,000 every year. So compared to the 10-year bond, which is more sensitive to the interest rate price risk, the 1-year bond is more sensitive to the interest reinvestment rate risk. So having either bond will not protect you against risk. If you have a short-term bond with high coupon bond, they will have low price risk, but they will have high reinvestment risk. If you have a long-term bond with low coupon bond, they will have a high price risk, but a low reinvestment risk. So when you're looking at bonds, it will depend of you, the investor, how much risk you want to take. Will you prefer to take a price risk, or will you prefer to take a reinvestment risk? So in addition to the price risk and reinvestment risk, there's another risk that most bonds can face, and this risk depends on who is the borrower, which company is the borrower. And this risk is called the default risk. So the default risk is the risk that the issuer will not be able to repay the bond. So if an issuer default, investor receive less than the promised return. Therefore, the expected return on a bond or municipal bond, a corporate bond or municipal, is less than the promised return. So if you have a bond from Apple and Apple default, that means you're not going to receive your principal, and you're going to receive an amount of money that will be lower than what you expected to receive. And how do you determine the default risk? It's influenced by the issuer financial strength. So if, for example, you have Apple, and we know that Apple has been here for a long period of time, and they have a good balance sheet, a good income, then that will influence your default risk. You're more likely to think that Apple is not actually going to have a high default risk, because they have a high financial strength. But let's say that you were working with Apple in the late 1990 or in the late 1980 when they had actually trouble and they almost went into bankruptcy. In that moment, any bond issued by Apple would have a high default risk. So it depends of the financial strength of the firm. It also depends of the terms of the contract. So how do you determine if a bond is risky or not? Hopefully you do not have to go yourself and look at all the balance sheet, the financial of the firm. There's actually company that do that. The rating agency will actually do that. So Moody's and S&P, that's what they will do. So they will look at the firm's financial and determine if the firm's bonds are of investment grade, if they have a higher default risk or lower default risk. So this table shows you the rating for most of the firms. What are the different ratings that they can have? If you have a rating of AAA to BAA Moody's or AAA to BBB S&P, you're going to be called an investment grade bond. So what's an investment grade bond? It's a bond that has a lower default risk and a bond that most institutions are going to trade because it has a lower default risk. And if you have, for example, a rating of AAA, whether it's S&P or Moody's, that means that your chance of defaulting is very low. If you have a BAA or BBB, your chances of defaulting are higher, but it's still safe to trade this bond. Then you have another category of bond, which is the junk bonds. This bond will have a very high default risk. So if you have a junk bond of C, the default risk is very high. The chances of you getting repaid is almost close to zero. And if you have a BAA, the default risk is high, but the chances of you getting paid is a little bit higher. So then this bond, what you'll see, they will have a higher interest rate because they're highly risky also. So what should the bond rating show you? They are designed to reflect the probability of a bond issue going to default. So the lower the bond, the lower the rating, the higher the year to maturity, the higher the risk. So if you have a bond that have a rating of C, they're more likely to have high yield to maturity, high risk. If you have a bond that has rating of AAA, they're more likely to have lower yield to maturity and lower risk. And this is the main relationship between risk and yield to maturity, and risk and bond rating and risk, and bond rating and yield to maturity. The higher the bond rating, the lower the maturity, the lower the yield to maturity, the lower the risk. The lower the rating, the higher the yield to maturity, the higher the risk. Okay. There are other factors that actually affect the default risk and bond rating of a firm. The financial performance of the firm will affect the default risk and bond rating. So if they have a high debt ratio, that means that they already have a lot of debt. That will affect the default risk. If they have a lower current ratio, that means that they're not liquid in the short term. That will affect the default risk. Other elements as like the bond contract terms will also affect the default risk. If it's a secured or unsecured, secured means that the bonds actually have a collateral. So then the lender is safe or the investor is safe. Senior debt, that means that you get paid first, so then it's safer for the investor, so that means it will be less risky. If there is a guarantee or sinking provision, that will affect the bond ratings, and if there's the longer or shorter debt maturity, that will also affect your ratings. Other qualitative factors that we not always look at but also affect the default risk are the earning stability. Is the firm able to have stable earnings over a period of time? The regulatory environment, is there any change in taxes that will affect the firm's financial, the potential antitrust and product liability, the pension liability, the labor problem. If there's any strike, that means that the company is not even able to function, so then the financial will be affected and the default risk will be higher. And also an element that have been found recently is that the board of directors actually affect the default risk, and there is a paper that I have for you to read on Canvas, and that will allow you to see how some of the qualification or some of the information about the board of director and characteristic about the board of director can actually affect your default risk. So this is it for chapter 7, bond valuation. I hope you were able to learn about how to value bond, how to determine the value of bond, and what are the different factors that affect the value of bond. And if you have any question, make sure to post it on the chapter 6 and 7 discussion board. Thank you.